Right now, as we watch the tickers flash across the screen, Nvidia stock is trading at $181.27, showing a fascinating push and pull dynamic in today's session. We are seeing intraday movements fluctuating between a low of roughly $179.11 and a high near $184.48, which tells us immediately that the market is wrestling with a very specific valuation ceiling. The stock is currently sitting up about 1.2% from its lows, but it is facing clear resistance every time it tries to break past that mid-180 handle. This price action is not just random noise. It is the heartbeat of a market trying to decide if the next leg of the AI narrative is a vertical sprint or a grueling marathon. Here is the immediate reality check that separates the casual observer from the serious analyst. Most people are looking at this price and wondering if the bubble is popping or expanding. That is the wrong question. The real insight, the one that isn't being headlined, is that Nvidia is transitioning from a hardware sales story to a capital expenditure utility story. The expectation is that Nvidia's growth must eventually slow down because how many chips can companies buy? The reality, which is significantly more bullish and complex, is that Nvidia is no longer selling a commodity. They are selling the foundational infrastructure of the modern economy, much like steel was to the industrial age, or oil was to the combustion engine era. When you see the stock hovering at $181.27, you aren't seeing a speculative bet, you are seeing the pricing of a new global utility. Let's pause and really look at what is happening with the volume today. We are seeing volume levels around 165 million shares, which is hefty but slightly below the average daily volume of 235 million. This indicates a wait-and-see approach from the massive institutional whales. They aren't selling off, but they aren't aggressively buying the breakout just yet. They are waiting for a confirmation signal, likely tied to the upcoming Blackwell architecture shipments and the resolution of some lingering supply chain bottlenecks. The general belief on the street, the coffee shop consensus, is that Nvidia is overpriced because its PE ratio sits around 45. People look at that number and get vertigo, but challenge that thought process. If you normalize that PE against the expected earnings growth rate of 50% or more for the next fiscal year, the PEG ratio, price to earnings to growth, is actually remarkably attractive, arguably cheaper than many slow-growth consumer staple stocks. The market is pricing Nvidia as if its growth is about to fall off a cliff, while every single data point from the supply chain suggests demand is accelerating, not decelerating. When we look at the broader sector momentum, we have to talk about the magnificent divergence. While you might hold Apple stock or Tesla stock and see them reacting to consumer trends or EV adoption rates, Nvidia is trading on a completely different set of macro drivers. It is trading on the capex widgets of 4 or 5 specific companies: Microsoft, Amazon, Google, and Meta. As long as those giants are locked in an existential arms race for AI dominance, they have no choice but to buy Nvidia hardware. It is a prisoner's dilemma, where if one stops buying, they lose the future. This provides a floor to Nvidia's revenue that is far more concrete than the fickle consumer demand that drives Apple stock or the interest rate sensitivity that drives Tesla stock. Let's analyze the recent price action in the context of the last few weeks. The stock has been consolidating in a tight range, bouncing between $170 and $190. In technical analysis, we call this a coiling pattern. Energy is building up. The bears are trying to push it down below the 50-day moving average, arguing that competition from AMD and custom chips from Amazon and Google will eat away margins. The bulls are defending the support levels, arguing that Nvidia's software moat, CUDA, is insurmountable. This consolidation at $181.27 is the calm before a significant volatility expansion. If we break $190 with conviction, we are likely looking at a run to new all-time highs above $200 very quickly. If we lose $170, we could see a flush down to $150 to shake out the weak hands. Speaking of hands, I want to hear from you. Comment below how many shares of Nvidia you currently hold, or if you are waiting for a dip to start a position. It is always interesting to see where the retail sentiment actually sits versus what the media claims. Now let's look at the institutional activity because that is where the real weight moves. We have seen some rotation recently. Major hedge funds have been trimming their exposure slightly, not because they dislike the company, but because of portfolio rebalancing rules. When a stock triples in a year, risk managers force funds to sell some just to keep it from becoming 20% of their portfolio. This forced selling creates artificial headwinds that smart individual investors can take advantage of. It is not a vote of no confidence. It is bureaucratic portfolio management. Meanwhile, retail investors using platforms like Robinhood Stock Trading or SoFi Invest have been stepping in to buy the dep, absorbing that institutional supply. This transfer of ownership from weak institutional hands forced to sell to strong retail conviction is often a bullish signal in the long term, provided the fundamental story remains intact. And that fundamental story is rock solid. Let's discuss the business model because it's often misunderstood. People think Nvidia sells chips. They don't. They sell a platform. When a data center buys an H100 or the new Blackwell system, they aren't just plugging in a card, they are installing an entire ecosystem of networking, InfiniBand, software, CUDA, CUDN, and reference architecture. This is why the competition argument often falls flat. Yes, AMD makes great chips. Yes, Google has its TPUs. But to switch away from Nvidia, a company has to retrain its entire engineering workforce, rewrite its codebase, and risk compatibility issues. The switching costs are astronomical. It's the same reason why people stick with Apple stock products, or why businesses stick with Microsoft Office. The friction to leave is just too high. This lock-in effect is what justifies the high gross margins, which have been hovering at an incredible 74–75%. But we must address the elephant in the room, the macroeconomic pressures. We are operating in an environment where interest rates are a constant conversation piece. While the Federal Reserve has signaled various moves, the cost of capital remains relatively high compared to the zero-rate era. This impacts the long tail of Nvidia's customers, the startups, the smaller research labs, the university projects. These groups rely on cheap debt to fund their compute clusters. If rates stay high, that segment of the market could soften. But here's the contrarian take. High rates actually help Nvidia's competitive position. Why? Because high rates kill off the venture-backed chip startups that were trying to compete with Nvidia. A startup needs hundreds of millions of dollars to tape out a new chip. In a high-rate environment, that funding dries up. Nvidia, with its massive cash pile and free cash flow, can outspend and out-innovate everyone else without needing to borrow a dime. They are essentially self-funding their own monopoly while their potential competitors starve for capital. Let's look at the specific revenue segments. The data center division is obviously the juggernaut, accounting for the vast majority of revenue now. It has completely eclipsed the gaming segment, which used to be the company's bread and butter. But don't sleep on the professional visualization and automotive segments. These are the sleeping giants. As self-driving cars move from science fiction to reality, the compute power required inside the vehicle is massive. Nvidia's Drive platform is positioned to be the brain of the autonomous future. Whether you are bullish on Tesla's FSD or Waymo, the underlying hardware trend favors Nvidia. And then there is the sovereign AI trend. Nations like Japan, France, and the UAE building their own domestic AI supercomputers to ensure data privacy and national security. This is a brand new multi-billion-dollar customer base that didn't exist 2 years ago. We also need to talk about the political risk, specifically China. The export controls are a serious headwind. The U.S. government has effectively banned Nvidia from selling its best chips to China. This cuts off a significant chunk of the total addressable market. The expectation was that Nvidia's earnings would be crushed. The reality, demand is so high elsewhere that it hasn't mattered yet. Nvidia simply rerouted the chips meant for China to customers in the U.S. and Europe who were desperate for them. However, in the long run, this forces China to develop its own domestic chip industry, which creates a future competitor that wouldn't existed otherwise. It is a classic case of short-term pain for long-term, well, more pain, potentially. But for now, the China drag is being completely offset by the hyperscaler demand. Let's discuss the future outlook and the catalysts waiting in the wings. The biggest one is the Blackwell platform launch. This is the next generation of GPU architecture. The performance leap is expected to be massive, specifically for inference, which is the act of actually using the AI models, not just training them. This is critical because the market is shifting from training, building the brain, to inference, using the brain. If Nvidia can dominate inference the way they dominated training, the bear case is dead. Inference is where the volume is. Every time you ask ChatGPT a question, that is inference. Every time your phone suggests a photo edit, that is inference. The volume of inference queries will dwarf training runs eventually, and Nvidia is positioning Blackwell to own that workload. Another catalyst is the software revenue stream.